So last week, we spoke about a non-recognition section, section 1058. Section 1058 was enacted so that the market could trade smoothly, that we never had to worry about shares not showing up for delivery. And it also facilitated short selling, and that when 1058 applied, neither gains nor losses were recognized. Today, we're going to talk about a different non-recognition section. It's code section 1091, and it deals with wash sales. So let me share the screen. Let me pull up the PowerPoint, and we'll go through it. Okay, so we're dealing with wash sales. And so the wash sales are governed by code section 1091. And Congress enacted code section 1091 because they thought investors were selling securities and then repurchasing them. And when they sold the securities, they claimed the loss, and then they repurchased the identical security, so their economic position hadn't changed, yet they were attempting to take a tax loss. So if you think about it, I could have bought a stock 5 years ago, and I have a large loss in that position. And then I want to recognize that loss this year because I have gains from other transactions. So I sell the stock at a loss, and then the next day I buy it back. Well, I really haven't gotten out of the position. I've been out of this position overnight, and yet I want to take a loss. And so Congress said, no, you have to wait. You can't just buy it back the next day. So then taxpayers said, well, all right, can I wait 2 days? Can I wait 3 days? And finally, Congress said, you know what? You have to wait 30 days. And so you don't just measure 30 days after you take the loss. The period that you measure is 30 days before the loss and 30 days after the loss. So if you sell a security at a loss, and within 30 days prior to the date of the sale, or within 30 days after such sale, you repurchase identical securities, then the following is what happens. The loss is disallowed. The disallowed loss is then added to the purchase price of the new securities to come up with the basis in the new securities. By doing that, we ensure that the loss eventually will be recognized. When the new securities are finally sold, then you can recognize the loss. So the loss isn't disallowed forever. It's really just deferred until you sell the replacement securities. And then finally, the holding period of the old securities is then added to the holding period of the new securities. And we'll see that could sometimes end up with a strange result. So what I'd like to do now is go to the whiteboard and let's go through some examples and see how these rules work. Move this out of the way. Let's make this larger. So let's assume that on January 5th, 2021, we buy 1,000 shares of IBM at $100 per share. So we spent $100,000. And then on 9/21/2021, we sell 1,000 shares of IBM at $75 a share. So we're getting $75,000. And all other things being equal, we would have a $25,000 loss, right? Our amount realized is $75,000. Our basis is $100,000. We have a $25,000 loss. So what I like to do is I start with the sale date. So whenever I see that I've sold some stock or a client has sold stock, I put down the date of the sale. And then I go back 30 days. You don't count the day of the sale. So in September, we have 20 days. And in August, we have 10 days. And that would be August 22nd. So from August 22nd to August 31st is 10 days. And then we have the 20 days in September. So the date that we go back to is August 22nd. And then going forward, we don't count 9/21. So we start with 9/22. So from 9/22 to 9/30 is 9 days. And we have 21 days in October. So we've got 10, 21, 20, 21. And I look at that time period. And during that time period, I want to see if we bought back any shares of IBM. And it turns out that on 9/1/2021, we bought 1,000 shares of IBM at $70 a share. Well, now we have a problem because during that time frame, we bought back the number of shares that we sold. That's the wash sale. So if you think about it, we started with 1,000 shares. On 1/5/2021, we had 1,000 shares. When after we sell, we then buy another 1,000 shares, we then sell 1,000 shares. So when we're all finished on 9/21, we still have 1,000 shares. We're right back to where we started from. And because we're right back to where we started from, Congress says you can't take that loss. All right, so we can't take the loss. So what happens? We now want to know what's our basis, and I'll do this up here. What's our basis in the new shares? And the way we come up with our basis is we start with our purchase price. And our purchase price was $70,000, $70 a share for $1,000 a share. And then we add to that the disallowed loss. And the disallowed loss was $25,000. And so our basis is now $95,000. Now, technically, if you go through the code and you go to 1091D, that tells you how to compute the basis. They don't tell you to do it that way. The code has you do it a different way. And it was written by someone who really likes algebra, and you end up with the same result. And if you go by the code section, it's a little confusing. So instead of trying to go through the code section, just remember that you take the disallowed loss, add it to the purchase price, and that gives you your new basis. So our new basis in the shares is 95,000. Now assume that on 12/31/2021, we sell the 1,000 shares at 65. So we're selling the shares for $65,000. Our basis, as we saw, is $95,000. And we have a loss of $30,000. Now, what I like to do is I like to check and make sure that the tax loss equals the real economic loss. And so the way I do that is I say, okay, what were my purchases? My purchases were my original purchase, $100,000, plus the second purchase, and the second purchase was $70,000. So my total purchases were $170,000. What were my sales? My sales were $75,000. And the second sale was $65,000. And that equals $140,000. So if my purchases were $170,000 and my sales were $140,000, I have a loss of $30,000. And that equals what the loss that we figured out that we have for tax purposes. So that lets me know that I've done it correctly. When the economics and the taxes come out to the same thing, you know that you've got the right answer. And now this is where I think the interesting part comes in. So if you look at it, we bought the stock on 1/5/2001. And we're selling, and we're doing the last sale at 12/31. So we've got 1/5/2021 was the initial purchase. And the final sale is on 12/31/2021. So and the final sale ends up with a $30,000 loss. So everything was done within the calendar year. You would think that if everything was done within the calendar year, this loss should be short term. So that's what you would think. Except let's see the way the code works. It says add the holding period of the original stock to the holding period of the subsequently purchased stock. So let's start with the holding period of the subsequently purchased stock. I bought the stock on 9/1, right? That's when we bought the stock that's creating the problem, and that's the stock that we're selling on 12/31. So 9/1/2021 through 12/31/2021 is 4 months. The original stock was purchased on 1/5/2021, and it was sold on 9/21/21. Well, that's 8 months plus 2 weeks, a little more than 2 weeks. So my total holding period equals 12 months plus 2 weeks. That's more than 1 year. So the loss actually long-term. Even though everything was done within a 12-month period, because of the way the rules work, we end up with a long-term loss. So I think that's a strange result. But that's what happens when the thing that creates the wash sale is done prior to the sale of the original stock. Because that period in between 9/1 and 9/21 is basically being counted twice. And because it's being counted twice, we end up with this strange result. Right? So if I sold 1,000 shares and I only bought back 500 shares, then the wash sale rules would only apply to 500 shares. So it's only the amount of shares that you're buying back. Also remember, we have this problem because in this transaction, when we're selling the shares, we're saying we sold the original shares. So when you say you sold the original shares, we look in this period to see if we bought any new shares. So what I want to do is change the facts slightly. We have the same thing. We buy shares on 1/5/2021, and we pay $100,000 for those shares, the same 1,000 shares. we buy new shares on 9/1/2021. And let's assume this time that we bought them for $75,000. And then on 9/21, we sell 1,000 shares, and we sell the 1,000 shares for $70,000. So let's just go back here. This is a buy. This is a buy. And this is a sell. Except when I sell my shares, I identify the sale as selling the shares bought on 9/1. Well, if I'm identifying the sale as selling the shares bought on 9/1, I end up with a $5,000 loss. But now I go back to that time period and I say, have I bought any other shares during that time period? I no longer count the 9/1 purchase because those are the shares that I'm selling. And because those are the shares that I'm selling, the only other shares of IBM that I own were bought on 1/5/2021. So there's no wash sale. Right? So when you buy shares and sell those shares within 30 days, that's not a wash sale. Now, there are sometimes you have a wash sale and you go, that just doesn't feel right. It's not, it shouldn't be a wash sale. The only problem is it meets the language of the code. So what do I mean by that? I'm doing a lot of trading in stock. And so on 1/5/2021, I buy 1,000 shares. IBM, again, at 100. So again, I'm spending $100,000. On 1/7/2021, I buy another 1,000 shares. At 102, the stock went up. So I'm going, oh, this was a great investment. I should add to my investment. And so now I own 2,000 shares. And then in the next week, IBM starts to go down. And I go, you know what? I shouldn't have bought that second 1,000 shares. I'm going to sell 1,000 shares and go back to my original position. So on 1/14/2021, I sell 1,000 shares. And I sell it at 98. And I say that I'm selling the second lot that I bought. So I have a $4,000 loss. This, believe it or not, is a wash sale. I mean, it looks like I went from 1,000 shares, I increased my position to 2,000 shares, and now I've decreased my position to back to 1,000 shares. And it really doesn't look like I'm washing anything, but the way the code section works, I bought the shares on 1/7, I sold them on 1/14, I now go back 30 days, and there's another purchase of 1,000 shares. This is a wash sale. So I'm going to contrast that with this situation. And this is the only situation where I would ever say that we have a reduction of a position as opposed to a wash sale. So on 1/5/2021, we buy 1,000 shares at 100. And then later in the day, I decide to buy some more. I buy another 1,000 shares. at 102. You know, IBM is going up. I'm excited. I buy more shares. And then on 114, 2021, IBM has gone down, and now I want to reduce my position. I want to go from 2,000 shares to 1,000 shares, so I sell 1,000 shares at 98. So again, I have a loss, and it doesn't matter which shares I say that I've sold, I have a loss. Now, this is very similar to the transaction before. The transaction before, I bought on January 5th, I bought more on January 7th, and then I sold on January 14th, and we said that clearly is a wash sale. On this one, I bought in the morning on January 5th, I bought some more in the afternoon on January 5th, and then I'm selling on January 14th. So if I go through the code says this is a wash sale, because I've sold the shares, I bought identical shares within 30 days, that's a wash sale. There's a revenue ruling, there's a 1958 revenue ruling. When we go back to the slides, I'll have the exact number for you. And that ruling says, because the shares were purchased on the same day, it can be treated as a reduction in position and it isn't a wash sale. Right? So when you buy multiple lots of shares on the same day and then you sell some of them within 30 days, you can rely on that 1958 ruling to say that's not a wash sale. But once you do stuff on different days, like the 1/5 and 1/7, that's it. That ruling doesn't apply and you've got a wash sale. So if you have someone that's trading stock every day and buying stock back every day, other stocks, so they're constantly trading the same stock and they end up with a net loss on their trading position. If they have to stop trading. In order to take the loss. We'll talk about a transaction that you can use to try to plan around this. But if you don't do anything special, they're going to have to stop trading for a 31-day period. And it's the net loss, because every time you have a loss, it just gets added to the basis of the next stock that you buy, and then you sell that and go back on and on and on. But it's the net loss. So the net loss is not going to be deductible if you just keep trading every day, and you never stop trading. You're not going to be able to take your loss, and you're losing money. You're not going to be able to take the net loss because of what happens with the wash sale. There are other rules that we have to take into account. But let me stop sharing. Let me just go back to the PowerPoint and make sure that I'm not leaving anything out. Plus, I want to give you that revenue number. So this is the basic rules that we talked about. The loss is disallowed, and it's 30 days prior to or 30 days after the sale that created the loss. The disallowed loss is added to the basis of the stock. And again, look at 1091D. It doesn't say that in words, but it ends up saying that in reality. And the holding period that created the wash sale includes the period of the property that was sold. And that was the rule that gives us the funny result that you could have a transactions all occurring within 1 year and end up with a long-term transaction. And that's code section 1223.3. Okay. In addition to selling stock at a loss and then buying back the same stock, there's something in the code, and it really doesn't follow economics. It really is a trap. So it's something you should be aware of. And that is if you sell a stock at a loss and then you buy a call option. So once again, we're dealing with options. You buy a call option on the same stock, and it doesn't matter what the strike price is. The purchase of that call is deemed to be buying the identical stock, the underlying stock. So if you sell stock at a loss and then either 30 days before the sale or 30 days after the sale, you buy a call on that stock, then it's automatically treated as a wash sale. And the basis in the call, you'll end up with a disallowed loss. The loss will be added to the basis in the call. And again, we don't care what the terms of the call are. We don't really care if economically it's substantially identical or not. So again, let's just do a quick example on that. And again, it's interesting because we keep talking about call options and how they affect the taxation of other transactions. And we haven't talked about the taxation of equity options yet. That's going to be the next class. So we will do that. All right. So again, we buy 1,000 shares of IBM at 100. So again, we're spending the same $100,000. We sell the 1,000 shares of IBM at 80. So we have a $20,000 loss. And then within 30 days, we buy, or the taxpayer, the investor buys 10 call options on IBM. And remember, each call option deals with 100 shares. So if we buy 10 call options, that's dealing with 1,000 shares. And we don't care what the strike price is. So we don't care if it's substantially identical. We don't do any analysis of economically whether the call option really is identical to the stock. Once you buy a call option, that's it. And so let's assume we bought a call option with a strike price of 80. And each option is trading for $5. So we spent $5,000 for the option. Buying those 10 options now disallows the loss on our 1,000 shares. We now add the disallowed loss to the basis. And now we have a $25,000 basis in our options. And the loss was disallowed. And again, when we sell the options or if the options expire, that's when we'll recognize the loss because we've just increased our basis from 5,000 to 25,000. We're actually going to use this rule as a planning technique because this rule really is not an economic rule. Options are not substantially identical to the underlying stock. But that's the rule in the code, so we have to follow it. And we'll talk about a couple of planning ideas that we can use using this as a weapon, using this as a sword instead of us being hurt by it. We can actually hurt the IRS with this. So we can use it as a planning technique. So again, remember, if you sell stock at a loss and you buy call options on the underlying stock, the purchase of those call options is treated as a purchase of the stock for wash sale purposes, and the loss is disallowed. So let's go back to the PowerPoint. And if you remember, writing a put option is similar to buying a call option. And so the question is, if you write a put, does that treated as a wash sale as well? And there's a revenue ruling on this. It's revenue ruling 8587. And the revenue ruling was written in using two negatives, which is a terrible way to speak English. And what it said was that if there is no reasonable chance of the put not being exercised, then it's going to be treated as though it was an acquisition of a call, and the wash sale rule will apply. So even though that's poor English, let's try to do an example to try to show how that works and try to turn it into some English that we can understand. So again, we'll go back to our IBM example. All right, I erased the whole thing. Okay. Again, we're going to these are the reasons, though, that why I really stress understanding the economics of options. So we're going to find when we do the taxation of options, it's not that complicated, but it's all these other uses of options and how they affect other code sections that becomes vital. So we buy 1,000 shares of IBM at 100. So again, we're spending the same $100,000. And IBM goes down to 80, so we sell 1,000 shares of IBM at 80. Well, we have our $20,000 loss. And we really say, you know, we don't really want to get out of our IBM position. We want to stay in our IBM position. So what do? We sell 10 puts with a strike price of 120, and they're going to expire in 31 days. So when you sell a put, that means that the owner of the put can force the seller to purchase IBM at $120 a share. And we've made it so that the puts can only be exercised on the expiration date. And those would be called European style puts. So an American style put can be exercised at any time, but a European style put can only be exercised on the date of expiration. Well, the date of expiration is 31 days from now. As long as IBM is under 120, 31 days from now, the puts will be exercised. And what happens when the puts are exercised? The investor is forced to buy back the shares. Now, in this fact pattern, it's pretty clear that IBM is not going to go from 80 to 120 in less than a month. So this is the fact pattern that the IRS was thinking about. And so here we use their negative language, and they would say there is no reasonable chance that the puts will not be exercised. You know, if you were speaking better English, you would say, are you certain, if it's certain that the puts will be exercised then treat them as a purchase of a call. So where the strike price is way above the fair market value of the stock, that's when you have the situation that there really is, that you really are certain that the puts are going to be exercised. So when they sold the IBM for 80, if they wrote puts with a strike price of 80, can we say that we know that there's no, that these puts are definitely going to be exercised? I mean, if IBM continues to go down just $1, the puts will not be exercised. So it becomes a judgment call. I'm pretty confident that if I wrote puts with a strike price of 80, that this ruling is not going to apply. We have no idea if the puts are going to be exercised. But if the puts had a strike price of 85, I'm going to start to feel less comfortable. I still think there's a good chance they won't be exercised because IBM could go from 80 to above 85. But that's going to become a judgment call. And so a lot of people say if the strike price of the puts is greater than the fair market value of the stock, then this rule applies. I think that's way too conservative. I think the strike price of the puts have to be far in excess of the fair market value of the stock in order for this rule to apply. But it becomes a judgment call. Okay, so buying a call we know creates a wash sale. If you sell puts, it may or may not create a wash sale. All right, and this was the ruling. So it wasn't a 1958 ruling. I apologize for that. It was a 1956 ruling. And it's revenue ruling 56602 that says merely reducing a position is not covered by the wash sale rules. That ruling again had the facts of that ruling was the stock was bought in the morning, some more stock was bought later in the afternoon, the same day. I think that's the only time this ruling will ever be applied. And that if you try to use this ruling by saying we're reducing our position and you acquire the stock in more than one day, it's just not going to work. So don't try to rely on this ruling. Okay, what about related parties? There's no related party rule. And so what people would do is they would sell their stock at a loss, and then they would purchase the identical stock in their individual retirement accounts. And they said, oh, we're not the same party. And there was a revenue ruling, 2008-5. And 2008-5 said that the wash sale rules applied. And there's no base adjustment given to the investor in the IRA. Instead, the IRA makes the basis adjustment in the shares it bought, except an IRA is a tax-exempt entity. What ends up happening when you apply this rule is that the loss is permanently disallowed. It really isn't the right result. And at conferences, the IRS said if you do the opposite, that if I have a loss in stock that I own in an IRA, and then I buy it back as an individual, then the wash sale rule doesn't apply. And again, let's just go to the whiteboard and show you the problem with the IRS's rule and why they're concerned about the transaction being done in reverse. So again, we're buying our same 1,000 shares of IBM. at 100. We're selling the 1,000 shares. At 80. We have a $20 loss. We've got a $20,000 loss. And then we buy 1,000 shares of IBM in the investors IRA, and an IRA is a tax-exempt entity. And the IRS said that the basis of the shares within the IRA is $100,000, that the disallowed loss gets added to the basis in the shares. Well, when the IRA sells those shares and it has a loss, it can't deduct the loss. That loss is meaningless. When investors receive money from an IRA, they compare their basis in the IRA with the amount of the distribution that they receive. And the excess is taxable. If we really wanted the loss to just be deferred and for it to never go away, the taxpayer should have been given basis. They should have increased their basis in the IRA. And then when they got distributions from the IRA, that would reduce the amount of income and the loss would truly have been deferred, not gone away forever. Okay, so, but that's not the rule. That's not what the IRS said in their ruling. The reason that the IRS says that, by the way, don't try to do this in reverse, because think about it. If the IRA sold 1,000 shares of IBM at a loss, the IRA can't deduct the loss. The loss does the IRA no good. And so now if the individual buys 1,000 shares within 30 days, and if the wash sale rules applied, then the investor would increase basis by the disallowed loss. And then when the investor sold the stock, they'd be able to deduct the loss. So you'd be taking a loss that an IRA can't deduct, and if you apply the rule in reverse, then the investor now all of a sudden can take the loss. And so without really explaining why the rule only works in one direction, the IRS has let people know that's the way it is, that the way they interpret the rules, it only works against the taxpayer. So if the taxpayer sells something at a loss and then they rebuy the shares in their IRA, the wash sale rules apply and the investor can't deduct the loss. On the other hand, if the IRA sells the stock and then the investor buys it back, the wash sale rules just don't apply. And the loss is just stuck within the IRA and there's no benefit for it. So again, you might think these rules make sense, but they're only going in one way. They only work to help the government. They're anti-taxpayer rules. Right. There's also a related party rule between spouses. So if one spouse sells stock at a loss, and then the other spouse buys stock within 31 days, or within 30 days, then the wash sale rules will apply. Okay, what if I have a short sale? I sell short IBM. IBM has gone up in value. I close out the short sale, and then I sell short IBM again. The same rules apply. So under Section 1091E, rules similar to those in Section 1091A shall apply. So if I sell stock short and I close a short sale and substantially identical securities were either sold or sold short, then the loss on the short sale doesn't apply. What's interesting, what's missing here is if I sell stock short, I close it to take a loss, and I buy a put option, there's nothing in 1091E that says that buying the put option should automatically trigger the wash sale rules. So unlike the long side, when I sell stock that I own, if I then buy a call option, that does trigger the wash sale rule. When I'm doing a short sale, I recognize the loss. I think you can buy a put option within 30 days and you don't trigger the wash sale. There's nothing in here that says that you should trigger it. Okay, so those are the wash sale rules. It's not super complicated, but those are the rules. Now, how do we plan around this? And they're very easy to plan around. So there are two transactions that all brokers that you read about them in the press, or you see them in the internet at the end of the year, and they remind people if you have losses and you want to take losses, beware of the wash sale rules. So they give you two ways of getting around it. First, they say, sell your stock, wait 31 days, and then buy the stock back. And that works. There's no question that works. Except that you're telling someone who bought the stock at 100, it now has gone down to 70. They sell the stock for 70, and you're telling them wait 31 days before you buy it back. Well, what if during the 31 days that they're waiting, the stock goes back from 70 back to 100? They've lost that increase. So you say, oh, if that's your problem, then what you should do is you should double your position. So you started with 1,000 shares, buy another 1,000 shares, then wait 31 days and sell your original 1,000 shares. So I bought 1,000 shares at 100. Now the stock's down to 70, and you're actually telling me to buy another 1,000 shares at 70 and wait 31 days and then sell the original shares. Well, if I double up and I buy another 1,000 shares at 70, what do I do if the stock goes down to 50? Now I've lost an extra $20,000. So while both of those transactions work, they actually change your economic position, which, by the way, is exactly what Congress wants. So if that's exactly what Congress wants, that's not what we want as investors or taxpayers. So what can we do? And there are a number of things we can do. Okay, so here's the case, the Doyle case. Doyle owned 10,000 shares of Corporation X, and it had declined in value. So what does Doyle do? Doyle buys an additional 10,000 shares and simultaneously sells short 10,000 shares. So if you think about it, if you buy 10,000 shares, and we've already gone through short sales and how the short sales work, and you sell short 10,000 shares, you haven't done anything economically. Those positions completely offset each other. Doyle then waited 31 days and he delivered the original shares to close the short sale. And under the short sale rules, the day that you deliver the shares is when you close out the short, and that's the day that you're deemed to have sold the shares. So again, let's go to the whiteboard. And let's see exactly what Mr. Doyle does. So he owns 10,000 shares of XYZ. He then buys 10,000 shares of XYZ. And he sells short 10,000 shares of XYZ. And again, what's key to this is that when you buy shares and you sell short the identical shares, you haven't done anything economically. Nothing has changed. Economically, he still owns 10,000 shares of XYZ. He then waits 31 days and he delivers the old shares to close the short sell, Since he waited 31 days, the loss was recognized on the closing of the short sale. The purchase of the identical shares occurred 31 days earlier. We're outside of the wash sale rules. Since we're outside of the wash sale rules, the loss is allowed. And that's exactly what the court held. The court said, look, we're just applying your rules. These are the rules in the code. When you enter into a short sale, it's not the day you enter into the short sale, it's the day you close the short sale that we measure it for tax purposes. And they bought shares 31 days before that, taxpayer wins. The Treasury and IRS did not like this. They immediately, within a few weeks after the case came out, the Treasury amended the regulations. And what do the regulations now say? Solely, and it's only for wash sale purposes, solely for purposes of the wash sale. The date the short sale is entered into is used to determine the 30-day holding period or the 30-day period. So in Mr. Doyle's case, if that was the rule, it wouldn't have worked because the day he entered into the short sale is the same day he bought the original shares. So Mr. Doyle's transaction doesn't work anymore. So is there a transaction that could work? And I wouldn't ask the question unless there was. So now what we do is we buy 10,000 shares of XYZ. And instead of selling short 10,000 shares of XYZ, because that doesn't work, we economically do the same thing, but again, we're using options. So what do? We buy 100 puts on XYZ, and we simultaneously sell 100 calls on XYZ. And the calls and puts will have the same strike price and expiration date. And if you do that, buying a put and selling a call is economically equivalent to a short sale. So we've done the same thing Mr. Doyle did, except we're using puts and calls instead of doing an actual short sale. And this works because the regulation doesn't cover this. The regulation only talks about short sales. It doesn't talk about puts and calls. So this is one way to get around the wash sale rule. You have shares, double up the way Mr. Doyle did, but then instead of selling short those amount of shares, buy puts, sell calls, have them go out 31 days. And then 31 days from now, you close out the puts and the calls and you sell your old shares. You're left with the new shares and you're able to recognize your loss. So that's one way to get around this. So Mr. Doyle's transaction can't be done, but we can come very close to it. Now, as I said, we're going to use the rule that's in the code that really doesn't follow economics and use it to our advantage. And whenever there's a rule in the code and it doesn't follow economics, two things can happen. One, it can be a trap for the unwary because you say, this rule doesn't make sense. It doesn't follow economics. I would have never thought that these would be the tax results. So if you're unaware of it, it really could be a trap. But if you're aware of a rule that doesn't make economic sense, more times than not, you can use it as a weapon. And this is one of those rules. So what do? And this way we can clean up a wash sale in a week. We don't have to wait 31 days to clean up the wash sale. Because even if we do the Doyle transaction, we still need 31 days because we're going to have to buy new stock. We're going to have to do the options transaction. Then we're going to have to wait 31 days before we can close it out. So if the client comes to you on December 5th, it's too late to do it this year. You're not going to be able to get the loss. If they come to you on December 5th, this is the transaction you talk to them about. On day one, you sell the stock at a loss. On day two, you purchase a call option. When you purchase the call option, the loss is disallowed. And the basis of the call then includes the disallowed loss. Day three, you sell the call. Now the loss is recognized. And then on day four, you purchase the stock. There's no wash sale anymore because there's no rule that says that when you sell a call option and then you repurchase the underlying stock, that's a wash sale. Now we look to see if they're substantially identical, and the way we would structure the trade, we would make sure that they're not substantially identical. Again, all of you have had me for Tax 627. The thing you have to worry about is the step transaction doctrine. Can the service say one step wouldn't have been done without the other? And maybe they can do that, and so I would try to spread the days a little further apart. And I might put a little more economics into the call, but not so much that it would be substantially identical. So again, this is the transaction. Let's just go to the whiteboard and let's write it out. And you want to buy a call that's very far out of the money, where the strike price is way above the stock price. But you want it to be realistic. You don't want the IRS to say this thing just has no economic sense whatsoever, because then they'll disregard the transaction. So again, we bought, sorry about that. We bought 1,000 shares of IBM at 100. So in total, it's $100,000. The stock is now worth $80 per share. So what do? We sell the stock. For $80. and we have a $20,000 loss. We then buy a call option, either the same day or the next day, buy a call option on IBM with a $90 strike price. So it's not going to be expensive because the strike price is way above the fair market value of IBM. IBM would have to go up by $10 a share for it to have any value. And let's give it a 2-week expiration. And let's assume that we can buy that call option for 50 cents. So again, it's on 1,000 shares. So we're going to have to spend $500 for the call option. But what's our basis in the call? Basis in the call is the $500 purchase price $20,000 disallowed loss, and we end up with a basis in the call of $20,500. Then a day or two later, we sell the call. And we sell the call for $500 because that's all it's worth. It hasn't changed in value, let's assume. Well, now we have a loss of $20,000, and we recognize the loss on the sale of the call options. Then we buy new stock. Well, the purchase of the new stock does not violate, this does not violate the wash sale rule. And why doesn't it violate the wash sale rule? Because the stock in the call, when the call is that far out of the money, it has such little time to go, it's not substantially identical to the stock, right? If IBM goes from 80 to 83, you lose all your money on the call option, you make $3 on IBM stock. It clearly is not identical to the stock. And there's no rule that automatically says that when you sell a call option at a loss and you buy back the underlying stock, that triggers the wash sale. So this does not violate the wash sale rule. Also, in the regulations, it says that when two transactions could create a wash sale within a 30-day period, you go in chronological order. So when we sell the IBM stock and then we buy a call option, that's it. The wash sale is triggered. And when we buy the new stock afterwards, there's nothing for it to trigger because the wash sale rule has already been triggered. So now we own the stock again. And the loss is recognized. So this is another planning technique that you can use to maintain your economic position in the stock and recognize the loss. And you can do this transaction within a few days. So if you have a client comes to you in December, and they have a loss they want to recognize the loss, without getting out of the position, this transaction can be done. So this is another way that you can maintain your position, recognize the loss, and not run afoul of the wash sale rule. So both of these planning transactions, the benefit that both of them have is that the taxpayer or the investor has never changed their economic position. They've retained their ownership in the shares and they were able to take the loss. That's why they're better than the double up transaction or sell the stock, wait 31 days and then buy it back. While those get around the wash sale rule, you have to change your economic position. And so that's not a good answer. So let's go back to the PowerPoint. And this is the last planning. So it's a different planning technique. What happens here is someone tells you that they've recognized a long-term loss. And they also tell you that they have other long-term gains and short-term gains. So if you'd rather have a short-term gain loss than a long-term loss, because the long-term loss is going to reduce their long-term gains, which would have been taxed at 20%. If instead they had a short-term loss, that would have gone against their short-term gains, which would have been taxed at 37%. So what do? And once again, we're going to use the same rule that says that when you purchase a call, you automatically trigger the wash sale rule. What we're going to do is we're going to sell, they've already sold the stock at a loss, so they've already done it. And they've come to you within 30 days. So you tell them, buy a call, but this time it's the exact opposite. You want to buy a call that's deep in the money because you want the call to reflect the ownership of the stock. So you tell them to buy the call, and then you tell them to exercise the call. And then after they exercise the call, tell them to sell the stock again, right? Because they really want to be out of the stock. They don't want the stock. So let's see what happens when they do that. All right, so again, exercise the call. When you, so you bought the call. The call triggers the wash sale rule. The disallowed loss gets added to the basis of the call. When you exercise the call, your basis in the call gets added to the strike price, and that becomes your basis in the stock. And then when you sell the stock, you recognize the loss again. When you exercise a call option, we haven't gone over this yet, you start a whole new holding period in the stock. That the holding period in the call is irrelevant. And the only thing that's relevant is what day did you exercise the call option. That's when your holding period in the stock begins. So again, I'm going to go to the whiteboard, and this is the last slide. So this is the last planning idea. And so this idea is to take a long-term loss that's already been recognized, and we're going to convert it into a short-term loss. And again, short-term losses are worth more to taxpayers if they have both other long-term gains and short-term gains. Sorry, I closed the whiteboard by accident. So instead of, I tried to make it bigger, and instead I closed it. So let's go through this again. What happens? Taxpayer tells you that they sold 1,000 shares of IBM at 80 for a $20,000 loss. And by the way, it's a long-term loss. And they have to tell you this within 30 days after doing it. So what you tell them to do is buy a call. And I want the call to be deep in the money. I don't want to have to pay a lot of extra to get this call. So we buy a call on IBM with a strike price of 60 with 1 week to maturity. And we pay $20 for call option. And again, we're going to buy 10 calls because we wanted to cover 1,000 shares. So in total, we paid $20,000 for the call option. Now we exercise the call. Well, once we buy the call, the purchase of the call triggered the wash sale rule. So what's our basis in the call option? It's the purchase price. And I apologize because I use the same number for the purchase price and the disallowed loss. But the purchase price is 20,000. And we add the disallowed loss. So again, we're purposely failing the wash sale rule. So we have a disallowed loss of 20,000, and our basis in the option is 40,000. Now, because the wash sale rule applies, the holding period in the stock carries over to the call option, and we have a more than 1 year holding period. In call option. We then exercise the call option. So I'm going to do that up here. Exercise call option. So first, what happens economically? Forget taxes for a second, but economically, the strike price is 60. So we have to pay 60,000 for the stock. And our purchase price of the call is 20,000. So we're buying the stock back in total for $80,000. And if you remember, that's what we sold it for, because the stock was sold at $80 a share. We sold it at for 80,000. So we sold it for 80,000, buying it back for 80,000. Economically, we really didn't do anything. Except that now what happens for tax purposes? For tax purpose, so we're buying the stock for 80,000, but for tax purposes, what's our basis? So the strike price is 60,000. Basis, sorry, let me fix this. The strike price is 60,000. Our basis was 40,000 in the call option. So our basis in the new stock is 100,000, and our holding period begins anew. The stock is still worth $80,000. So now we sell the stock for $80,000. And what do you know? We have a tax loss of 20,000, which is what we had before, except now the tax loss is a short-term loss. So once again, we're using the same rule, and it's an uneconomic rule, but it's there. When you purchase a call, that triggers the wash sale rule. It's right in the code. There's nothing you can do about it. And so again, we're using that rule to our advantage. In this transaction, we're converting what was a realized long-term loss into a short-term loss. And in the other transaction, we were maintaining our economic position in a stock and still creating a loss without violating the wash sale rule. All right, so that wraps up wash sales. Again, the rule isn't that complicated. You sell a stock at a loss within 30 days before or after that sale, you repurchase identical stock, or you purchase a call option on that stock, you've triggered the wash sale rule. The loss is disallowed. The loss gets added to the basis of the property that created the wash sale, and the holding period of the old stock gets added to the holding period of the property that, again, created the wash sale rule. And then what gets interesting are the planning techniques that can be utilized to avoid the wash sale. Right, so that wraps up our discussion and our class on wash sales.